Just looking at the results again, as I mentioned a while ago, it seems that the lodging and fee-related business were some of the bright spots that really stood out for CapitaLand's first half report card. Do you think that's a fair assessment, or do you think there are some more challenges that under the hood with regards to those two particular segments of CapitaLand's business?
Morning, JP. Thanks for having me on the show. I think you're absolutely right. Those are the two parts of our business that's doing really well right now, particularly the lodging business. Lodging's been outstanding for us. We're seeing good global recovery, not just in Singapore, but in our properties in Europe, in Japan in particular. We've seen good recovery. So lodging management-related fees for us are up 35%. We think that's going to continue in the second half. We may not see the same 35% number, because last year, second half was pretty good for lodging as well, but we do think that momentum is going to continue. And with, I think yesterday there was a little bit more relaxation on some of the restrictions from China on group tours coming out. We think that's going to help our lodging business as well. So we think momentum there will continue. On the fund side, on the fee-related earnings, we did have good, steady, recurring fees from particularly the listed and private funds over the last 6 months. We didn't have as much event-driven fees, which is a little bit of weakness there. But the recurring component increased by almost 10%. I think that part was very encouraging. Hopefully, second half of the year, we see a little bit more deal flow, and that will help pick up a little bit more on our event-driven acquisition fees. And
that's something we talked about before the interview as well, this lower number of lower deal-making environment, really driven by a cautious approach, at least, outlook by the global market with regards to the macroeconomy. How is that guiding CapitaLand's strategy? I know you have a target to raise about $3 billion in terms of asset recycling. You're at about $839 million, I believe. Are you confident you can actually hit that target, Paul?
Well, historically, if you look at us over the last few years, we've done anything between $3 billion to $13 billion in divestments in a single year. This year, I have to say, is a little bit unusual. Where we are in the first half, being below $1 billion at this point, is a little bit slower than we would like. I think we're going to have to see how the market conditions are for the rest of the year to see whether we get a little turnaround, that momentum. If you look at us on an overall business, that portfolio divestment component is down, and that's actually, I would say, the main driver for the difference in our total PATMI numbers year on year for the first half. But the operating business has been surprisingly resilient. Operating business from an operating PATMI level is basically flat, just 1% difference. And as you mentioned, right, the higher interest rates, higher borrowing costs, despite that, for most of our properties, the net property income went up enough, together with some of the cost savings, lower OPEX, to kind of offset that higher borrowing cost. So net, I would say from an operating perspective, it went well. Divestments, hopefully it picks up second half of the year, but I think at this stage, hard to guarantee